Hello, this is Jordan, and this video is being recorded on Sunday evening, April 24th, 2022. Hope you all had a great weekend. Thank you so much for tuning in. And in this video, I'm going to discuss some of my current macro views and this possibility of inflation peaking and why a peak in inflation and then a falling rate of inflation is going to be or would be bullish for gold. And I'm not making this out to be a bait and switch where inflation's going up, that's bullish for gold. Now I'm not making this a situation where everything that happens is bullish for gold, but I will explain. Again, thank you for tuning in. Make sure you subscribe to the channel if you haven't already. Thank you. And this is the only chart I have in this update, and I know there's a lot to take in here, and I can go on and on for this. So I'll just go row by row here. And so starting off with the top two rows, we have the real 5-year yield, and then we have gold below that, and also GDX below that, because obviously GDX and gold, they trend fairly closely. And so with respect to the real 5-year yield, I mean, if we look at the arrows, we can see that the real 5-year yield bottomed in summer of 2016, right around the time gold peaked. And also, more recently, the real 5-year yield essentially bottomed in early 2021. So gold peaked before that happened. So, I mean, every relationship in the market is not always perfect, but for the most part, I mean, that relationship was a couple months off. The last little decline in real yields, gold did not rise as it should have. But anyway, we can see that everything comes back to real interest rates for gold. That's the primary driver for gold. And we can see that while real interest rates, over the last 12, 18 months, I mean, they haven't really made a significant rise, at least until recent months. And so we can see that, they put in a low. You can see the blue arrow there. And obviously they weren't rising much. They were kind of trading along a bottom. They weren't going anywhere. But nevertheless, gold having come off a huge move, if real yields, I mean, just by the fact that they weren't going down anymore, that was going to put pressure on gold. And, very recently we can see that the move up that gold had, that, it appeared to be a $300 move in, I want to say 6 weeks or so. That was actually supported by a decline in real yields. So we did see a decline in real yields, but now they're resuming their uptrend. And so that accounts for why precious metals are selling off hard and why they're probably going to be weak here in the very short term. But, moving down to the CPI. So again, for precious metals, it comes back to real interest rates, not the CPI. The CPI and the rate of inflation is a component of that, but it's secondary. And so if we look at the CPI, and so we're talking about the rate of inflation, that peaked in the middle of 2018, in July 2018. But then gold and gold stocks, as you can see, they bottomed like a month after that. And, more recently, if we look at after the COVID crash, so the CPI bottoms, it starts rising. And then at the beginning of 21, that's when the CPI really takes off and really accelerates. So we can see in the last 15, 16 months, that's when the CPI has gone from 1% to 8%. But if we look at that period, gold and GDX, for their entire correction, silver as well, they have not been able to make a new high. So during the period that precious metals have been correcting, this 18, 19, however long it is right now, they've essentially been correcting the entire time. You can say that until they make new highs. They've been correcting. The CPI went from 1% to 8%. And so it's a little bit out of whack, but again, the problem is if we look at real yields, they haven't gone up a ton, but for most of that period, real yields have been rising. I mean, if you look at the 10-year yield and especially the 2-year yield, they have been rising quite a bit. So even though inflation has gone from the rate of inflation has gone from 1% to 8.5%, for the most part during that time, real interest rates were not going down. So, I mean, it is kind of bizarre, but that leaves us where we are. And, it explains why we're setting up for something that we had similar to 2018 and similar to most of gold's history, aside from the inflationary periods in the 1970s. And that's when the Fed, usually precious metals make a bottom around the time the Fed stops hiking rates. And then when the Fed they start cutting, that's when they really accelerate to the upside. And, if you go back to 2018, that bottom came 4 months before they did the last hike. So, I mean, there's nuance to how that works in the timing, but that's what we're setting up for here and now, because the Fed, if we're looking at Fed funds futures in the market, the Fed is going to be really aggressive over the next 3 months. The market is pricing in 1.75% of rate hikes because the Fed knows they got to get these hikes in really fast. They're way behind the curve. And so they're going to hike aggressively, and that's why we're seeing things sell off. And then the real question is what happens after that. Can they get to 3% like they want, or are they going to have to quit at, if they do that, what the market is saying, 1.75%, that puts the target rate up to a high of 2.25%. So how much more after July, how much more is the Fed really going to be able to hike, especially if we get a peak in commodity prices and, we see long-term bonds. If long-term bonds start rising, then the Fed maintaining this aggressive posture and hiking rates in that scenario, the curve could reinvert again. And, when that happens again, that's when the Fed is probably going to have to stop, and eventually turn their focus to when are we going to have to cut rates again. So, I mean, that was a lot to take in, but that explains why. And by the way, when that happens, when the Fed is when they stop hiking rates in the coming months, whether it's in 1 or 2 months or 4 months or 6 months, that's going to coincide with a peak in real interest rates. And then real interest rates are going to go down as the market senses the Fed is going to have to cut again, and inflation is coming down. So that explains why a peak in inflation is likely to be bullish for precious metals, and it's going to set up the next bullish catalyst. Now, if I'm wrong about this, the other scenario would be inflation remains really high and, growth, everything rolls over, but inflation remains stubbornly high. In that scenario, that's stagflation. In that kind of scenario, you would still get that move in precious metals. It's just that, the economy is still growing, employment is still growing. Maybe it's going to peak really soon, but those things have still been happening, and the Fed hasn't quite tightened enough to affect the economy yet. And so that explains why we're not really into stagflation yet. But I favor the scenario of inflation's probably going to peak. And that doesn't mean it's going to go from 8% to 0% or 1%. It can go from 8% a year to 4 or 5%. You can still have stagflation. It can still be a major problem. And so the other thing, if we look at the bottom of the chart, precious metals, they haven't really been correlated to, if you look at commodity prices, and then you see copper stocks, energy stocks, I mean, they all moved after gold's peak in summer 2016. And then they rolled over and didn't perform when gold had its move up from the summer of 2018. And if we look at, what's happened since that summer 2020 peak for gold and silver as well, I mean, look at energy stocks, look at copper stocks, the commodity price, they've all gone much, much higher. So we could be approaching a situation where, I mean, if it's the scenario where inflation peaks and doesn't have to roll over significantly, but if it peaks, rolls over a little bit, there's concern about growth again, that scenario is going to be really bullish for precious metals. There might be some initial selling like we're seeing now, but that's a really bullish scenario for precious metals. And not the other, the other aspects, energy stocks, uranium, commodity, copper, they could get hit while gold is bottoming and then turning up in that scenario. So I know that was a lot to take in, but that's just part of what my macro view is right now, and I'll continue to adjust that as new data comes in. Thank you so much for tuning in. Follow all my work here, as well as thedailygold.com, and look forward to doing another video update for you guys in the days ahead.